Welcome to the deep dive. Ever looked at a stock price maybe, or heard about a company buying a patent and just thought, how on earth did they get that number? It's definitely not guesswork, believe me. Today, we're taking a really fascinating deep dive into financial valuation methods, our goal, to give you the essential insights, that kind of shortcut to understanding how pretty much everything, a share, a factory, even an idea, gets valued.
That's right. We've looked through a bunch of material and we're going to guide you through the core ideas. We want to unpack the methods, the assumptions behind them, and why it all really matters. Let's sort of demystify this whole valuation thing.
Okay, let's jump right in then. When we talk about valuing a public company, the starting point is often security valuation, figuring out what a stock is actually worth. And our sources point to two main ways of thinking about this: absolute value and relative value.
Yeah, and what's really interesting is they offer such different perspectives. Absolute value is trying to find that intrinsic or true worth based purely on the asset itself. Relative value, though, it's all about context. How does this stock or this company compare to its peers out there in the market?
Okay, let's tackle absolute value first. These models, they're basically about looking into the future, right? Predicting cash flows.
Exactly. Predicting future cash flows and then, crucially, discounting them back to what they're worth today. You have to account for the time value of money and, of course, risk.
So it's like saying money later isn't worth as much as money now.
Precisely. A dollar today can be invested and earn more, so a dollar promised next year is worth less than a dollar in your hand right now. That's the core of present value.
So to build this up, let's start simple. An annuity. That's just a series of equal payments over a fixed time.
Correct, like getting $100 every year for 10 years. But what if those payments just kept going forever?
Okay, that sounds like a perpetuity.
That's exactly it, a perpetuity. It's a stream of equal payments that never ends. It sounds theoretical, maybe, but it's super useful for valuing things like preferred stock, where the dividends are usually fixed and paid indefinitely. The formula itself is quite elegant. Stock value P equals the constant dividend D divided by the required return R, P equals DR.
So using the Baker Corporation example from our sources, they pay a steady $5 dividend. If you, the investor, want a 20% return, you just do $5 divided by 0.20.
Yep, which gives you $25 per share. Simple, but it shows the principle clearly.
But it hinges completely on those inputs being right and staying right. The dividend never changing, the required return staying put.
Absolutely critical point. The assumptions are everything. If you assume that dividend stays constant forever, any small change in your required return, maybe because interest rates shifted, can have a huge impact on that calculated value, especially for something meant to last forever.
Okay, but most companies do change. They grow, hopefully. Dividends might increase over time. How does that fit in?
Well, that leads us naturally to the next step. The constant growth dividend discount model, often called the Gordon growth model, or just DDM, it takes a perpetuity idea but adds a constant growth rate for the dividend. So the formula adjusts a bit. It becomes P equals D1.
RG.
Okay, break that down. P is still price, R is required return.
Right. D1 is the dividend expected 1 year from now, so it incorporates that first year of growth, and G is the constant perpetual growth rate of that dividend.
And that R, the required return, it's not just arbitrary, is it? How do investors figure that out? Does it relate to risk?
Oh, absolutely. It must relate to risk. A very common way to estimate R for stocks is the capital asset pricing model, the CAPM. It considers the risk-free rate, like what government bonds pay, the stock's beta, which is a measure of its volatility compared to the whole market, and the overall expected return of the market.
Yeah.
It basically quantifies the return you should demand for the risk you're taking.
So back to Baker Corp. Dividend is $5 now, but it's expected to grow at 4% a year. Required return is still 20%. How does that change the value using DDM? Okay, so D1, the dividend next year, would be $5 times $1.04, which is $5.20. Then you plug it into P equals D1, or G. So $5.20 divided by 0.204.
20 minus 4 is 16. So $5.20 divided by 0.16.
Exactly. That calculation gives you $32.50 per share. So you see, adding that 4% growth significantly increases the calculated value compared to the no-growth $25.
Yeah, that makes sense. But there's a catch with the formula, right? R has to be bigger than G.
Yes. That's a crucial mathematical and logical constraint. The required return must be greater than the growth rate. If you assumed growth was higher than the return investors demand, the formula would give you a nonsensical negative price or infinity. It also implies that over the long run, the stock price itself should grow at roughly the same rate, G, as the dividends are growing.
DDM is great for dividend payers. But what about companies that reinvest everything and don't pay dividends? Or what if we want to look beyond just dividends? Is that still DCF?
Yes, definitely. DDM is just one flavor of discounted cash flow or DCF analysis. DCF is the broader umbrella term. It's about finding the present value of any relevant future cash flows the company is expected to generate.
So what other kinds of cash flows can we discount? What other DCF models are there?
Well, beyond dividends, you can look at free cash flow. There's free cash flow to the firm, FCFF, which is cash available to all investors, debt and equity holders after investments, or free cash flow to equity, FCFE, which is cash available just to equity holders after debt payments. These are really powerful for companies that don't pay dividends, maybe high-growth tech firms.
Okay.
There are also residual income models looking at earnings above the required return, but the basic DCF process is always similar. Choose your cash flow measure, forecast it out, pick a discount rate like from CAPM, calculate the present value, and then compare that intrinsic value to the market price.
Right. So that's the absolute side digging for that true value based on future cash. What about the other approach, relative valuation? How does that work?
Relative valuation is, well, exactly what it sounds like. It's about comparing. You look at how similar companies or assets are priced in the market and use that information to value your target company. It often uses price multiples. These are ratios comparing the stock's price to some fundamental metric per share, like earnings or sales or book value. It's a quicker way to get a sense of whether a stock looks cheap or expensive compared to its peers. Very intuitive.
And the most famous multiple has got to be the PE ratio, right? Price to earnings. Why is that one so dominant?
It really is. It's probably the most widely quoted and used multiple. And the reason is simple. Earnings are seen as a primary driver of investment value in stock prices. The ratio is just the stock's current market price divided by its earnings per share, E. Simple as that. P over E.
But there are different ways to calculate the E part, aren't there? Like looking back versus looking forward?
Good point. Yes, there's a key distinction. Trailing PE uses the company's past earnings, usually the last 12 months, EWO. Forward PE uses analysts' expected earnings for the next year or period, E1.
When would you use one over the other? Is forward generally better?
Forward PE is often preferred because investing is about the future, right? But you need reliable forecasts. Trailing PE is useful when forecasts aren't available, or maybe if the future looks unusually uncertain. So, for example, if Baker's expected earnings next year are $2 per share, and similar companies trade at a PE of 7.5, you'd multiply $2 by 7.5 to get an expected price of $15 for Baker. It's a quick market comparison.
But a simple PE doesn't tell you about growth, does it? A fast-growing company might seem expensive on PE alone, but maybe it's justified.
Exactly. That's the limitation PE has. Which brings us to another useful multiple, the PEG ratio, price earnings to growth. The PEG ratio tries to account for that growth factor. You calculate it by taking the PE ratio and dividing it by the company's expected earnings growth rate.
So PEG equals PE.
And lower is better here. Generally, yes. A lower PEG suggests you're paying less for each unit of expected growth. It helps compare companies with different growth rates more fairly than PE alone.
The Baker example again. If its PEG is 2.5x, current EPS is $5, and growth is 4%, how does that work out to a price?
Okay, so PEG equals PE.
Yeah.
G. We know PEG is 2.5 and G is 4 as a whole number. So 2.5 times 4, which is 10.
Right.
PE is 10. And since PE equals price EPS and EPS is $5, price equals PE times EPS. So 10 times $5 gives you a current price of $50. Oh, wait, the source says $52. Let me recheck the example. This source might have used slightly different numbers or rounding in its intermediate steps, but the principle is PE equals PEG G and price equals PE EPS. It shows how PEG links price, earnings, and growth.
Okay, that makes sense. What about companies that aren't making profits yet? Startups, maybe? Or companies in cyclical industries where earnings bounce around a lot? PE wouldn't work well there.
Precisely. That's where the price-to-sales ratio, or PS, comes in very handy. Sales are generally more stable than earnings and harder to manipulate through accounting choices. Plus, almost every company has sales, even if they're not profitable yet. So you can always calculate PS. It's simply price, P, divided by sales per share, S. Our sources suggest it's good for mature cyclical firms or those loss-making growth companies.
And what about cash flow? We talked about DCF. Is there a price to cash flow multiple too?
Yes, there is. PCF. Similar logic. Cash flow is often seen as a purer measure than earnings because it's less subject to accounting adjustments. The PCF ratio tends to be more stable than PE. And some studies suggest changes in PCF are linked to long-term stock returns. Calculation is just price P divided by cash flow per share, CF.
Okay, one more major category, the balance sheet.
Yeah.
Can we value a company based on its assets and liabilities? Book value.
Absolutely. That's the price-to-book ratio, or PB. It compares the stock's market price to its book value of common equity per share. Book value is basically assets minus liabilities, and preferred stock the accounting value of what shareholders own. PB is usually more stable than PE, especially if earnings are volatile or negative. Like PS, it's usually positive, so it's usable when EPS is negative. It's often used for valuing banks or industrial companies with lots of tangible assets.
The source has an example for Bolding Corporation. Stock price, $18, book value per share, $12. So the PB is just 18 divided by 12.
Exactly, 1.5 or 1.5x, as we'd say. The source also shows calculating their PCF multiple, which comes out to 6.0 in that example. It just demonstrates how you apply these different ratios using the company's data. But connecting all these relative multiples back, remember, they all rely implicitly on assumptions about the future earnings, future growth, future cash flows, and these numbers can be influenced by how management runs the company or presents its financials. They're not magic numbers.
Got it. So we've covered stocks pretty thoroughly, absolute and relative valuation. But valuation applies way beyond just stocks, right? What about other things?
Oh, absolutely. The core principle is discounting future benefits. Comparing to similar assets, they're incredibly versatile. We can use them for debt instruments, for options, for physical assets, even for intangible things like patents.
Okay, options. Those contracts giving the right to buy or sell, they seem tricky to value. How is that done?
They are complex. You've got American options you can exercise anytime, European ones only at expiry. The two big models mentioned are Black-Scholes and the binomial model, also called Cox-Ross-Rubinstein.
We're getting into heavy math now.
Haha, no, don't worry. The detailed calculations are definitely beyond this deep dive. But the key takeaway is what they consider. Black-Scholes, mainly for European options, looks at the stock's current price, the option's exercise price, the risk-free interest rate, time left, and crucially, the stock's expected volatility. How much is it likely to move? The binomial model, often for American options, uses a kind of decision tree. It maps out possible future stock prices and calculates the option's value at each step, working backwards. Both assume efficient markets.
Okay, so models exist based on key variables like time and volatility. What about something more straightforward, like bonds? How do we value debt?
Bonds are a classic present value calculation. A bond's value is simply the present value of all the cash flows it promises to pay. That means the regular interest payments, called coupon payments, plus the final repayment of the principal amount, usually $1,000 when the bond matures. You discount each of those future cash flows back to today using a discount rate that reflects current market interest rates for bonds with similar risk.
The source gives an example. A $1,000 bond, 3 years left, pays 4% interest annually. But the current market rate for similar bonds is 5%. What does that mean for its price?
This shows the key relationship. Since the bond's 4% coupon rate is less than the 5% market rate investors can get elsewhere now, this bond isn't as attractive. It will have to sell for less than its $1,000 face value. It will sell at a discount. To find the exact price, you'd calculate the present value of each $40 interest payment for 3 years, plus the present value of the final $1,000 principal payment, all discounted at the 5% market rate. The source calculates this total value as $972.77.
So lower than face value. And if market rates had dropped below 4%, it would sell for more than $1,000.
Exactly. That's the inverse relationship. Rising market rates mean falling prices for existing bonds, and falling rates mean rising prices. It's fundamental to bond investing.
Okay, moving from financial paper to physical stuff. How do we value tangible assets, like a factory, machines, buildings?
For those physical, tangible assets, property, plant and equipment, or PP&E, there are several common approaches. One is the cost method. You start with what you originally paid, the historical cost, and then subtract accumulated depreciation.
Makes sense. What else?
Then there's the market value method. This tries to see what similar assets are worth in the current market. Two ways to look at this. First, replacement cost. What would it cost to buy or build a similar asset today? The source example is $6.2 million for equipment. Second, net realizable value. What could you sell the asset for today minus any selling costs? The example is $5.9 million. Either can be a reasonable estimate depending on the situation.
Okay, cost or market. Any others?
Yes, you could use the appraisal method. Hire a professional appraiser who specializes in that type of asset buildings, machinery, whatever it is. And finally, there's liquidation value. This is usually the lowest value what you'd get if you had to sell the asset quickly, maybe in a forced sale.
Right. Now, for the really tricky one, intangible assets, things you can't touch, patents, trademarks, copyrights, brand value.
Right.
How on earth do you value those?
Haha, yeah, they are challenging, but increasingly important. These non-physical assets represent future economic benefits. The main valuation approaches actually mirror some we've seen. First, the market approach. If possible, you look for recent sales, licenses, or transfers of similar intangible assets. The problem is, many intangibles are unique and they don't trade often, so finding good comps can be tough. The source mentions finding 4 comparable patent sales between $15.1 million and $18.5 million, suggesting a median value around $16.5 million. So if you can find market data, it's usually preferred.
Okay, what if you can't find good market comparisons?
Then you often turn to the income approach. This is basically DCF again. You estimate the future cash flows that the intangible asset itself is expected to generate over its useful life, and then you discount those cash flows back to the present. The discount rate here is crucial and needs to reflect the specific risks of that intangible generating those cash flows. The example given is a patent expected to bring in $4 million a year for 10 years. Discounted at 5.5%, its present value is calculated at $30.15 million.
Makes sense value based on future earnings. What's the third approach?
The cost approach. This is generally used when you can't reliably estimate future income and there's no market data. It focuses on what it would cost to recreate or reproduce the intangible asset today. This includes everything: materials, labor, overhead, legal fees, development costs, maybe even opportunity costs. The source example, Alpine Inc., calculated the reproduction cost for its copyrights at $112,000. It's like asking, what would it cost us to build this again from scratch?
So listening to all this, valuation seems packed with estimates, assumptions, judgments, all the way through. How does the world of accounting handle this inherent uncertainty?
That's a really important point. You're right, many numbers on financial statements aren't perfectly precise. They rely heavily on accounting estimates. Think about estimating bad debts for accounts receivable, or valuing inventory at a lower of cost or market, figuring out depreciation for buildings and equipment, or even setting aside money for potential lawsuits, contingent liabilities. These all involve estimation.
What goes into making a good estimate? What data do companies use?
Management needs to look at various things. Historical data is key, like how many receivables went bad in the past. Market information, what's inventory worth right now? Expected usage patterns, how long will we really use this machine for depreciation? And sometimes they need input from experts, like lawyers estimating potential litigation losses. Good estimates need solid documentation of the assumptions, regular review, and auditors checking if they're reasonable.
This seems to lead directly to the concept of fair value. It sounds like a standardized way to deal with all this estimation and reporting. What exactly is fair value?
Fair value is a central concept in modern accounting, aiming for relevance. The formal definition, according to our sources, is the price that would be received to sell an asset or paid to transfer a liability. In an orderly transaction between market participants at the measurement date, in the principal or most advantageous market under current conditions.
Okay, whoa, that's dense. Let's unpack that. Orderly transaction, what does that mean? Not a fire sale.
Exactly. Not a forced liquidation. It implies normal market exposure, enough time to find a buyer, usual marketing efforts, and market participants.
Who are they?
They are buyers and sellers who are independent, knowledgeable about the asset, able and willing to transact, and acting in their own economic best interest. So informed, rational players.
Okay, and then this principal market versus most advantageous market thing. That sounds complicated.
It can be nuanced. The principal market is simply the one with the highest volume and level of activity for that specific asset or liability. If there is a principal market you can access, the price in that market is your fair value, period, even if another market seems to offer a slightly better price on the surface.
So volume trumps potential price.
If it's the principal market, yes. Now, the most advantageous market comes into play only if there isn't a principal market. It's the market that gives you the best net price after considering transaction costs, like commissions. But here's the twist. You use transaction costs to identify the most advantageous market, but you don't subtract them when determining the final fair value figure itself. You use the quoted price from that market.
Ah, okay. The Foxyco stock example helps here. Trading in New York and London. If NY is principal, fair value is $52. If London is principal, $50. But if neither is principal and London gives a better net price, $48 after costs versus $46 for NY, you still use London's quoted price of $50 as the fair value, ignoring the transaction costs in the final number.
You got it. That's precisely the rule. Transaction costs help pick the market if there's no principal one, but they don't adjust the fair value itself. It keeps the value based on the market quote. And this leads to another interesting point for non-financial assets, like land or a building. How does highest and best use fit into fair value?
Right, because a piece of land could be used for different things.
Exactly. For non-financial assets, fair value considers how market participants would use the asset to generate maximum economic benefit, its highest and best use. So you might compare the value of a factory site used as it is versus its potential value if cleared and used for, say, residential development, even considering demolition costs. This concept doesn't apply to financial assets like stocks or bonds because they don't really have alternative physical uses.
Is there a formal framework, then, for how companies should actually go about measuring fair value? Some set rules?
Yes, thankfully. US GAAP provides a clear framework. It specifies the valuation techniques companies can use and, importantly, sets up a hierarchy for the inputs used in those techniques, ranking them by reliability.
What are the main valuation techniques allowed?
There are three broad approaches entities can use. The market approach, using prices and other relevant info from market transactions involving identical or comparable assets or liabilities. Basically, looking at market trades. The income approach, converting future amounts like cash flows or earnings into a single present value amount. That's our DCF again. And the cost approach, looking at the current cost to replace the service capacity of an asset, often called current replacement cost. The key principle is always to use the technique that maximizes the use of relevant observable inputs and minimizes unobservable inputs.
Okay, observable versus unobservable. That sounds like this hierarchy of inputs. How does that work?
This hierarchy is crucial for transparency and understanding reliability. It ranks inputs into three levels. Level 1 inputs. These are top priority, the most reliable. They are quoted prices in active markets for identical assets or liabilities that the company can access. Think of a stock price on the NYSE for a heavily traded company. Unadjusted, directly observable.
Gold standard. What's level 2?
Level 2 inputs. These are inputs other than level 1 quoted prices that are still observable, either directly or indirectly. This includes quoted prices for similar assets in active markets or quoted prices for identical assets in markets that are not active. It also includes things like interest rates or yield curves that are observable. So still market-based, but maybe requires some adjustment or isn't for the identical asset.
Okay, still based on market data, but maybe not perfect. What's level 3?
Level 3 inputs. These are the lowest priority and least reliable because they are unobservable inputs. They reflect the company's own assumptions about what market participants would assume. You only use level 3 inputs when observable level 1 or level 2 inputs are unavailable or too costly to get. Think complex derivatives or private equity investments where there's no active market.
So the hierarchy tells users of financial statements how much judgment went into the fair value number. Level 1 is market-driven, level 3 is based on internal models.
Exactly. It provides crucial context about the reliability of the fair value measurement.
Wow, okay. So wrapping this all up, what's the big takeaway for you, our listener, from this deep dive? We've covered a lot of ground in valuation.
We really have. From trying to nail down that absolute intrinsic value using DCF to the more comparative relative valuation using multiples, and then applying these ideas to bonds, options, buildings, even patents. You hopefully now have that shortcut, that better framework for understanding the core principles behind how financial value is determined.
Yeah, it's definitely not just one simple formula. It's a whole toolkit, right?
Okay.
Different methods for different situations, and each one comes with its own set of strengths, weaknesses, and those really critical assumptions.
Which leads to maybe a final thought for you to mull over. Knowing about these different methods and, crucially, their assumptions, how might that change the way you read financial news or look at a company's annual report or even think about your own investments?
Right. When you see a valuation number now, maybe ask yourself, what method do they likely use? What assumptions about growth or risk or the market are baked into that number? Are they reasonable? What happens if they change? Being aware of that makes you a much sharper, more informed participant in the whole financial conversation. And that's all the time we have for this deep dive into financial valuation methods. Until next time, keep digging deeper, keep learning, and stay well informed.